Welcome back to European Markets. Today is the 27th of March 2023, and my name is Peter Schaffrik. Usually we talk macro, but today I think it's absolutely relevant that we take a step back and take a look at the turmoil in financial markets at large. Well, as this is originating in the financial sector, today I'm going to be joined by Nicola Dransfield. She's part of our credit strategy team, and she looks after financials. So we've got the absolute expert in the room. Very quickly, just to set the scene, the chart that you're currently looking at shows the performance of European banks relative to the European stock index. And as you can see, they outperformed quite significantly going into the latest turmoil, but obviously have dropped quite substantially. The second chart that you're looking at shows kind of the same thing, just in reverse. It shows credit spreads, or rather the iTraxx Senior Financial. And what you can see is we had a quite significant tightening in credit spreads, but lately have seen a significant increase again. Not quite to the levels we've been before, but significant enough. Well, Nicola, just to start us off, I would say that the turmoil actually started in the US, but very quickly morphed into a European situation as well, particularly around Credit Suisse. Would you mind just sort of setting the scene here and telling us what actually is going on with Credit Suisse?
Yeah, hi Peter, absolutely. So I think the thing we need to remember when it comes to Credit Suisse is that the bank was going through a very difficult time to begin with. It was undertaking a complicated restructuring, and by nature of that, generating net losses. It had certain control issues, outstanding litigation, and towards the end of last year had suffered quite a large degree of asset outflows as people generally just became more concerned about the overall health of the bank. So when the US bank situation sort of started off, this naturally led people to consider what might be the next crack in the system. And that's really when Credit Suisse emerged as perhaps the weakest link in Europe. So this situation naturally deteriorated. People were concerned that we would again see these large asset outflows, to the extent that over the weekend, a deal was brokered such that UBS, a big solid bank, would take over Credit Suisse. This type of solution we've seen before, where you take a robust, solid operator such as UBS, get them to take over the struggling bank, Credit Suisse. But the deal is structured in such a way that there are certain financial benefits and perhaps even regulatory support for the acquiring bank, such that investors can be reasonably assured that the combined financial profile of the new group is relatively sound. And that's really what we saw happening with Credit Suisse and UBS, and what really helped to stem the fears around Credit Suisse.
Well, if I can sort of have a follow-on question on that. I mean, you just mentioned stability as the key outcome here, but clearly we haven't really seen stability thereafter straight away, particularly as far as the issue with the so-called AT1s are concerned. Maybe can you, sort of just fill us in exactly what the AT1s are and what was the issue?
Sure. So, I mean, an AT1 instrument is effectively a junior subordinated form of debt. So if we think about the credit hierarchy, the most junior form of capital is equity. That's then followed by your junior subordinated debt, senior debt, etc. So the way that it's supposed to work is that losses would first flow to equity holders and then to your junior subordinated debt, being your AT1s, etc. Now, what happened in the Credit Suisse UBS transaction, the AT1s of Credit Suisse were effectively written off to zero. So your AT1 bondholders are getting zero. Now, this caused quite a substantial negative reaction in the AT1 market at large. And I think that's really because of two reasons. So firstly, this is probably the biggest AT1 write-off that we've ever seen. And it was happening for an issuer that's a globally relevant bank. Secondly, in this instance, AT1 bondholders are clearly intended to get zero, whereas your Credit Suisse shareholders are still getting something. They're going to be getting UBS shares. And that is just simply not how the credit hierarchy is designed to work. And therefore, we saw concerns spread to the AT1 market at large, and therefore we saw the sell-off there. Now, what then happened was we saw other regulators come out, such as the Bank of England, the EBA, and say that if they were in a similar situation, they would look to respect the creditor hierarchy. And that then helped to kind of alleviate concerns to some extent within the AT1 market.
So, Nicola, people come to me and ask me if there's a problem with banks, there's a problem with European banks, and specifically whether it's on any scale comparable to 2008. I don't think so, but you're the expert. What do you think?
Yeah, I think for me, if we take a step back and we look at the first 3 months of this year, we can see that sentiment towards European banks was very positive. And I think that's quite clearly indicated in the chart that you showed earlier. Now, there's a few good reasons for this. Firstly, we're getting rate hikes in Europe, something which we haven't seen in many years, and this feeds positively into bank revenues. Secondly, with the latest set of results for the fourth quarter of 2022, we saw that bank balance sheets are generally in quite a good place. Asset quality metrics came in better than expected, and capital levels overall look generally quite robust. So I think when we look at the situation of what's played out in the US with Credit Suisse, certainly bank investor confidence has been dented, and I think investors will be selective on a name-by-name basis. But do I think that comparisons to 2008 and widespread concerns of the European banking sector are warranted? Absolutely not.
Thank you, Nicola. That's really helpful and very insightful. So my takeaway is that we probably don't look at 2008 redux. However, having said that, there will almost certainly be some repercussions on the economy at large. The chart that you're currently looking at shows the ECB's bank lending survey. And as you can already see, the situation was deteriorating already beforehand, and it probably hasn't gotten better since. What you're also seeing, and that's the second chart that you're now seeing, is that in Europe, corporate lending still is predominantly done through banks. So if the bank lending conditions deteriorate, and a large part of corporate funding is done through banks, we would expect some macro repercussions. Having said that, the ECB is still worried about inflation, core inflation, and generally the direction of travel of the economy still looks reasonably healthy. So do expect still further rate hikes. But I think the situation that we have clearly warrants being monitored very closely. And maybe just as a closing thought, one of the things that I'm personally looking for is that the primary markets open again. They have done so for corporate credit. And I hope going forward, they will also open again for financials. But that hasn't happened yet. I'm pretty sure we're going to look at that when we meet again. I thank you for watching, and I thank you, Nicola, for sharing your insights.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.